huge debt come credit bubble. Now, when that starts imploding, what you're going to get is you are going to get a weakening dollar. The dollar is going to go down, its purchasing power is going to go down, and if you like, the first signal we've got of that is the gold price measured in dollars rising.
I am suggesting that it makes arithmetic sense to me that the nominal gold price could increase to mirror the decline in the purchasing power of the US dollar over the next 10 years. I don't see any way that we can manage $130 trillion in aggregate liabilities growing by $4.5 trillion a year without allowing the purchasing power of the US dollar to decline.
What happens when the world's largest credit bubble finally bursts? Alasdair Macleod, head of research at GoldMoney, warns that the global financial backdrop is dominated by an enormous debt-fueled credit bubble. He argues that once this bubble begins to unwind, the US dollar will weaken dramatically, eroding its purchasing power. The first clear sign of this shift, he notes, is already visible in the rising gold price when measured in dollars, gold being real money without counterparty risk, unlike credit. Despite steadily climbing long bond yields since crossing 3% in early 2022, the S&P 500 has surged from 4,200 to 6,500, seemingly ignoring valuations altogether. Macleod emphasized that holding fiat money in the event of a currency collapse is pointless. It will lose value so rapidly it might not even buy a cup of tea. Gold, on the other hand, preserves purchasing power. Even if exchanged for depreciating paper currency, he argued, the key is to spend that paper quickly before further decline. Looking ahead, Macleod warned that the U.S. faces mounting risks from extraordinary federal spending and deepening recessionary pressures, both of which will worsen the budget deficit. A president openly calling for a weaker dollar only adds to the strain, further undermining confidence in the currency. Meanwhile, U.S. long bond yields have been capped near 5.1% for over a year, but technical patterns suggest that once this level breaks, yields could surge sharply, potentially triggering broader financial instability. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll keep delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
You know, if you've got unbacked fiat dollars, they're not going to buy you a cup of tea at the end of the day. On the other hand, if you've got gold, you can cash that in for worthless dollars, which you'll spend extremely quickly before they become even more worthless. I mean, that was the lesson, really, of that experience. And not only that, but if you do have gold, and particularly if you've got legal tender, it varies, the laws vary from country to country, but if you've got legal tender, then you can presumably use your gold to buy real estate, for example, or buy farmland, or nice country estates, or a hideaway away from anywhere, which might insulate you from trouble. But I mean, this is a very, very serious issue. It's going to be very damaging for virtually everybody, because let's face it, very few people actually have gold, or have gold in any sort of meaningful way. I mean, we haven't even touched on problems that follow. I mean, if we pursue the analogy with Germany, of course, the complete collapse of the currency and the economy in 1923 led to political instability. It led actually to Nazism, Hitler, and all the rest of it, and World War II. So the idea that this is just going to get the whole thing out of get it out of the system, and then we can get on with lives. And it's not that simple. It really is not. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies. And the thing that is actually very worrying is I can't see how any politician in the West has the mandate to actually address the problem. And it's in that context we should be more sympathetic about the problems that the German political class felt or faced back in the early 1920s. I'm sure, and if you read into it, you will find that there were people who knew what they were doing They knew that what they were doing was wrong, but they basically had no alternative. That was the way of it. Well, the UK and Japan are leading yields upwards at the long end. They're hitting new high ground, highest levels of years seen for a long, long time. And they're not the only G7 nations with this trouble. I mean, we've got Germany, notably. It's the 30-year Bund is yielding more and more and more. It's just going into new high ground the whole time. Ones that are left behind a little bit, but threatening to break out. The most important of which is really the United States. If you look at the long bond yield, it was capped at about 5.1%. I think it's sort of, I can't remember, but 18 months ago, something like that. And since then, it's been oscillating between sort of 5% on the upside and sort of 4.8, 4.7 on the downside. But, the oscillations have dipped. They haven't dipped as far every time. So you've got this chart pattern, which quite clearly shows that the moment it breaks up above 5.1, that yield is going to soar. Just imagine what that does to US government finances. I mean, I think what it reflects is an increasing investor perception of risk in investing in US treasuries. So why should they be worried about risk? Well, I think the answer partly is that the US economy is going into recession. And this means that the budget deficit will be far higher than currently expected, currently forecast by analysts and indeed, the Congressional Budget Office. If it does that, then from the point of view of investors, what they see is effectively a debt trap. And you've got debt traps really in all the G7 countries. And what a debt trap is basically a situation where the debt is soaring out of control, while at the same time, the revenue income that a government gets is declining. And so any sign that the US economy is stalling is very bad news when it comes to the yields on the long end of the US Treasury market because of the debt trap. And virtually all the G7 economies have this trouble. I mean, we've got riots in France because the government can't get through the necessary cuts in public spending to balance the books. We've got the same problem in this country. The government tried to balance the books by proposing some fairly minor welfare cuts, and that was thrown out by some parliamentary party. And it's a different situation in the United States. You've got a spendthrift president who seems to be completely oblivious to the real situation. And he's saying he wants the dollar lower, and too late Powell should be cutting rates and all the rest of it, putting a lot of pressure on the Fed, I must say. And I see that Mirren, his nominee to join the FOMC, has been approved by the Senate committee, so that now goes up before the Senate. So it'll be, he's a shoo-in now, let's face it. I wouldn't be surprised if Trump starts pushing him to be the next, president of the chairman of the Fed, replacing Jay Powell, because he retires next year. I mean, so really, we're looking at a situation where public sector spending in federal spending in America is increasing at a phenomenal rate. The recession, I mean, look at the unemployment numbers. The recession that is now becoming more and more obvious means that will be even higher. The budget deficit will be even higher. And yet you've got a president pushing for a weaker dollar. I mean, it's going to go weak anyway on that basis. And you're going to get higher rates at the long end, whatever happens at the short end of the yield curve. I mean, it's not good. It really is not. When you look at the, if you like, the credit background, look at the way in which we've got inflation. We are in a huge debt become credit bubble. Now, when that starts imploding, what you're going to get is you are going to get a weakening dollar. The dollar is going to go down, its purchasing power is going to go down. And if you like, the first signal we've got of that is the gold price measured in dollars rising. So we're talking about the relationship between real money without counterparty risk and credit. Secondly, we've got the long bond yield, which will break out above that 5.1% level, I think fairly shortly. Could be within weeks. And thirdly, we've got the extreme valuation disparity between the yield on the long bond and what's going on in equities with the S&P hitting new highs. I mean, since that first peak at about 5.1% in the long bond, I mean, you would think, well, no, go back a little bit. When it broke out of a long-term downtrend of yields, I'm going back to, 2022, around about early 2022, when it soared through 3%. We had, at that time, I think the S&P was around about 4,200, something like that. Now it's 6,500, despite the long bond yield continuing to rise. In other words, this is a bubble. Who cares about valuations? We're going to buy because it's rising. And you got the speculation in Bitcoin and all the rest of it. I mean, this is a speculator's market. It is a credit bubble. When that bursts, it's going to have a profound effect on the dollar.
Rick Rule explained that the primary driver for gold today is the growing concern over the erosion of purchasing power in US dollar, denominated and other fiat-based assets. He argued that this trend has staying power even if gold pauses temporarily, because the investor base currently engaged with the metal is still relatively small. As more investors begin to doubt the dollar's ability to preserve value, gold is positioned to capture a larger share of global investment flows. Rule pointed to the 1970s as a historical parallel, when the dollar lost about 75% of its purchasing power in a single decade while gold prices surged 30-fold, underscoring gold's role as a hedge against currency debasement. He also emphasized the importance of measuring assets in terms of gold rather than dollars, as this perspective strips away distortions caused by a weakening currency and reveals the true cost of assets over time. Between 2000 and 2025, gold appreciated at a compounded annual rate of about 9.25%, far outpacing U.S. housing prices, which grew at a slower rate of roughly 4 to 5% per year. Rule highlighted that maintaining liquidity, even if it feels costly in terms of lost purchasing power, remains essential for investors who want to seize opportunities when they arise, further reinforcing gold's enduring role as a benchmark for real value. Let's get back to the interview.
I would suggest that concern over the deterioration in the maintenance of purchasing power in US dollar denominated or fiat denominated instruments is the primary driver for gold. Unfortunately, I think that is sustainable. It wouldn't surprise me to see gold level off for a while because the community that's currently interested in gold is fairly small. And let me define that. JP Morgan Chase suggests that the market share of precious metals and precious metals related securities in the United States is only 0.5%, which is to suggest that 0.5% of savings and investment assets in the United States is denominated in precious metals or precious metal securities. Interestingly, that's down from a mean over 40 years of 2%, which will tell you how small the asset class is. I suspect that for reasons that we'll probably get into later in the interview, that concern about the maintenance of one's purchasing power in the US dollar will grow. And as a consequence of that, gold's market share relative to other asset classes will increase, and gold's space in investors' psyches will also increase. I think we have a dishonest default where we do what we did in the 70s. We allow the purchasing power of the US dollar to deteriorate to the extent that we pay back 25 cents. Many people don't realize it, but in the decade of the 1970s, according to the then Office of Management and Budget, the purchasing power of the US dollar declined by 75% in 10 years. Not coincidentally, the gold price increased 30-fold. I'm not suggesting to you, Alex, that the gold price is going to increase 30-fold. It's already increased 12-fold since the year 2000. I am suggesting that it makes arithmetic sense to me that the nominal gold price could increase to mirror the decline in the purchasing power of the US dollar over the next 10 years. I don't see any way that we can manage $130 trillion in aggregate liabilities growing by $4.5 trillion a year without allowing the purchasing power of the US dollar. First of all, I recognize that I'm going to achieve a suboptimal outcome. I, I accept that. I own gold, not because I'm trying to make money, but because I'm trying to maintain my purchasing power. One of the things that I've done since 2000 is I've maintained a separate alternative ledger, figuring out my income, my expenses, my net worth, my investment portfolio in gold denominated terms. I don't live my life in gold. I maintain a lot of liquidity in US dollars because I believe in liquidity. But I save in gold and I measure in gold. If you measure in gold and you look at housing prices in 2025 in gold terms, housing is cheap. Energy is cheap. Wages are cheaper. Gold relative to the US dollar has increased in the period 2000 to 2025 at 9.25% compounded, whereas the increase in housing prices has been more like 4.5 or 5% compounded. If you measure housing in dollars, housing is substantially more expensive. But because of the relative rate of valuation escalation in gold, what you see is that in the period 2000 to 2025, housing prices denominated in gold have declined by 18% or 20%. I think both things have happened. I think what's happened is that the United States has done a better job than the rest of the world with some intelligent and some unintelligent immigration. I think that liquidity in the U.S. has increased. And I think, of course, the demographic boom of the baby boomers has meant that in many metrics, the housing market is dearer than it was in 2000. But measured against the golden constant, measured against a medium of exchange that's simultaneously a store of value, the price increase in housing has been at least moderated and in most extents negative. And I'm not suggesting that your listeners denominate their whole lives in gold. I don't. I maintain a reasonable bit of US dollar liquidity, even understanding that I'm losing purchasing power as I do it. I'm getting paid, 4%, 4.5% in short-term treasuries. And my belief is that the purchasing power of my savings is declining by 7.5%. So I'm actually losing 3% a year in purchasing power, real purchasing power by savings. But if you have a crisis-born liquidity event, which I think there's a high likelihood of in the next 10 years, having the cash gives you the tools and hopefully the courage to take advantage of it as opposed to being taken advantage of by it. So when I described earlier in this interview my portfolio as being suboptimal, it's suboptimal because I have a lot of liquidity that's costing me purchasing power. If I was young and aggressive, I would probably have that money in tech stocks that I didn't understand. That would be, over the last 5 years, a more optimal, according to modern portfolio theory, allocation of capital. But that's not the way I roll. 2009 was an extraordinary year for me because I went into 2008 extremely well capitalized. And the consequence of that is that when the prices of a lot of stuff I was interested in fell by 60%, I had the courage, born of age, to act. And I think it's not unlikely, not certain, but not unlikely that I'll have that opportunity again. I need to say, I'm not necessarily a U.S. bear. I think that U.S. dollar hegemony will decline. I believe that the U.S. dollar will be the world's reserve currency when I die. For the record, I hope that's not soon. Healthy 70-year-old. But I think that U.S. hegemony will decline. I don't think that the US dollar will do badly in relative terms, but I think it'll do badly in absolute terms, meaning that if the US dollar loses 75% of its purchasing power over 10 years, a basket of competing currencies probably loses 80% of their purchasing power. The American share of global investable wealth is about 23%. That's down over 20 years from 32%, and that will continue. Investors who want to insulate themselves from the disintermediation of power from the United States to the rest of the world need to globalize themselves. They need to begin to understand that now. And I'm not suggesting that American dominance goes away. I'm just suggesting that our hegemony declines.
Gold remains central in a world of weakening fiat currencies, rising debt, and fragile credit markets. While assets like housing and equities appear increasingly expensive in dollar terms, gold reveals their true value, often showing them to be cheaper over time. Maintaining liquidity, though it erodes purchasing power, provides the flexibility to act decisively when crises emerge. With U.S. dominance gradually declining and global wealth dispersing, diversification becomes essential. Gold continues to serve as protection against inflation, a safeguard for purchasing power, and a reliable measure of stability in uncertain times. How much more global wealth could flow into gold as trust in fiat currencies declines? Stay tuned. If you're interested in real, data-backed insights on the financial system, be sure to like and subscribe so you never miss our weekly updates. Thank you for your support, and we hope you enjoy the video.